Welcome to our special show, The State of the Economy, where we're awaiting the numbers, some key macro data numbers that are expected shortly. One on the consumer price inflation data and the second on the industrial production or IIP data. Both should be on your screens very shortly. Our poll, meanwhile, had thrown up that for the month of February, the CPI number is expected at around 5.12%, which is not much of a change from the previous month's reading of 5.1% that we got in January. In fact, there was a whole wide range of estimates that we'd got from our poll, and those range between 4.9 to 5.3%. Remember, for this current quarter, that is the January-March quarter, RBI has estimated a CPI to average around 5%. So we'll have to see how this month's number adds up. Apart from that, of course, we'll be watching out for what happens on the food price front. That has been a bit of a downer on the overall CPI numbers. And of course, the core inflation number. Again, core inflation has been trending lower at around 3.4, 3.6% levels. That is widely the expectation that it will continue to remain steady. Not much of a sharp decline is expected as of now. So while we're standing by for the numbers, let's also quickly run you through the, okay, we have the numbers with us. First, CPI inflation, that has come in at 5.09%, which is just a tad above what our poll had estimated. In fact, almost in line with the 5.12% we were working with. And the IIP number, the other big number, that has come in at 3.8%, which means it is flat compared to the previous month's number, which was 3.8% in December. So those are the two key numbers. Of course, we're going to wait by for more details on both of those to get you the statistics on, you know, where the culprits are, what happens to vegetable prices, cereal prices. We're standing by. Now, let me also introduce you to our guests who will be giving us their perspective on these numbers. We have with us Aditi Nayar, the Chief Economist at ICRA. We have Nikhil Gupta, the Chief Economist at Motilal Oswal. Rupa, Rege, Chief Economist at L&T Finance. And also Devang, Shah, the co-head of Fixed Income at Axis AMC. Ladies and gentlemen, thank you very much for joining us. We're still waiting to get more of the numbers. We have the two headline numbers on IIP and CPI. Rupa, let me start with you. What was your estimate of the CPI number? It's come in at 5.09% for the month of February compared to 5.1% that we saw in January.
I was expecting it to be around 5%, 5.0%. So the actual number is slightly higher than that because we had seen sequentially easing of many food article prices, including, cereal prices and some select varieties of pulses like masoor dal, etc., some edible oils. And also base effect was quite favorable for the month of February. So, 5% or 5.1%, it's not much of a difference. But inflation has remained steady. And I think one of the contributory factors is the sustained decline in core inflation. And that's because, Reserve Bank has stayed in a tight liquidity mode, which has helped to a great extent in controlling inflationary impulses.
All right. Aditi, your quick thoughts as well. I think you were working with a CPI estimate of 5.1%, just a tad below that.
That's right. So pretty much this is coming in line with our expectations, although there were some food items which were showing a fall in prices in the month of February. Vegetables were not really throwing up the kind of easing that we had initially expected, which is why we had upped our forecast to 5.1%, pretty much flat on the previous month. And I think after this number, we will continue to expect a sub 5% print for March, but just barely sub 5%. So not the kind of deeper correction that we were initially expecting for the month of March.
Nikhil, if you've been able to get any other internals as well, of course, core inflation is one big number. That's now flashing for you on the screen, 3.3% compared to 3.6%. That's a positive. Core inflation actually coming down month on month. I mean, remember the 6% odd levels we were seeing in 2023 to now 3.3% core CPI. That's a good number. Nikhil, quick thoughts.
Yes, hi. Thank you very much. Okay, so you're right. Core inflation is 3.3%. First of all, headline inflation at of 5.1% is in line with our forecasts, but the internals are very different. Core inflation, as you rightly pointed out, actually dropped to 3.3%, which is the lowest reading on record since 2012, since when we have this series available. But the food inflation was at 8.6%, which was higher than our forecast of 8.4%. Again, within vegetables, within food, we saw vegetables inflation higher than what we anticipated. We saw meat and fish inflation much higher than what we anticipated. Cereal and pulses were slightly lower than what we anticipated. But broadly, the headline inflation seems like at close to 5%. It is an acceptable number. There is no surprise there. So I think this would be a kind of non-event as far as markets are concerned.
Okay. Devang, just stand by. We have more details on all the numbers that come in besides the headline number, of course, of 5.09% for CPI, for instance. The cereals and products, a heavy weightage in the basket, of course, that inflation rate at 7.6%, meat and fish at 5.21%, egg inflation at 10.69% is the number that we're getting, which is actually higher month on month if you compare to the 5.6% kind of an inflation that we saw in the previous month. You have milk and products at 3.86%. That's a tad lower month on month if you compare the numbers. Oils and fats continues to remain in the negative territory. That's good news. We're still reaping the benefits that we've been seeing through last year, minus 13.97%. Fruits inflation at 4.83%. This is a sharp reduction from the previous month's 8.65%, I think, or thereabouts that we saw. Again, vegetable continues to remain the culprit as it has been now at 30.25%. That's the kind of inflation that we're talking about, slightly higher than previous months where we had about 27% inflation in vegetable prices. Apart from that, you have pulses and products, 18.9% inflation. That's down marginally from last month's 19.5% inflation that we saw. Sugar and confectionery, 7.48%. That is the number that we have, almost in line with the reading that we had for the month of January. Spices, 13.51%. This is again a tad lower than the previous month. Non-alcoholic beverages, 2.97%. And overall, if you look at the consumer food price index, that actually coming in at 8.66%. So RBI repeatedly has been highlighting food inflation is where the concerns are. You're seeing what's happening on the vegetable prices front. Cereal inflation also, although it's come down month on month, remains high at 7.6%. So that is as far as the CPI numbers are concerned. Aditi, if I may quickly come back to you and on some of the internals and what you made of it. Of course, vegetable prices in the winter months, we're expecting some downward revision, but what did you make? I mean, the key culprits, of course, vegetables, cereals, pulses as well.
See, cereals and pulses, typically when they start to become a problem, the problem is sticky for a longer period of time. Vegetables, we were more hopeful that with cooler temperatures, we'll, get to see the seasonal downtrend and some of the specific issues will start to resolve themselves. But we really haven't seen that kind of relief that we were hoping for. And now, of course, we're already in the middle of March. By April, May, we'll start to get back into summer pricing so that dip in the vegetable price inflation that we were hoping for, even on month terms. Now, I don't think we're really going to end up getting that very significantly. And going ahead also, the next monsoon is going to be very critical for the food inflation trajectory going ahead. And let's see, even now, building in a 4.6% average CPI inflation next year, we're still working with food inflation average, which is about 5%, and that itself is predicated on the monsoon being normal. So fingers crossed, we don't end up with too much of a negative surprise in FY25.
Well, we'll have to wait for those numbers. Let me also quickly read out for our viewers some more details that are coming in on the IIP data that we have. The headline number that we've already flashed for you, of course, is already there. Apart from that, you have mining coming in at 5.9%. Yes, that's the number that we have for the month of January. Manufacturing, against heavy weightage in the IIP basket, that is come in for the month of January at 4.5%. And then, of course, you have electricity that grew by about 5.6% is the number for the month of January. Overall, IIP number, of course, coming in at 3.8%. We'll also try to read for you some of the other internals in terms of capital goods, consumer durables, and so on. Okay, so IIP again for the month of January, the kind of growth that we're seeing in these numbers. Let me start with primary goods. There we've seen a growth of about 2.9%. In the case of capital goods, we've seen a growth of 4.1% for January. In the case of intermediate goods, we're seeing 4.8% again growth. And infrastructure construction goods, 4.6%. Apart from that, you have consumer durables, that growing at 10.9% month on month. That's a year-on-year number. That's a good number. And then, of course, lastly, we have consumer non-durables. That's a minus 0.3% number. That's a bit of a howler. Rupa, what did you make of that? We have consumer non-durables in the IIP data minus 0.3%.
Yeah, this is perfectly in line with expectations because you see most of the FMCG companies have been cautioning that they may not see revival until the September quarter of 2024-25. And we have seen that last year's, El Nino weather conditions have significantly impacted water reservoir levels and yields also. So, even in rural belts, we are observing a trend towards premiumization. So in rural belts, demand coming for consumer durables and all is holding firm. But for consumer non-durables, the demand conditions are still muted because cash flows of farmers and non-farmers in rural belts have been adversely impacted this year. As Reserve Bank, one of the MPC members had rightly pointed out, the high food inflation actually has impacted the purchasing power of masses in rural belts. So if we've continued weakness in FMCG has to be seen in that context. And within industrial sector, you see still the growth momentum is more concentrated in infrastructure, construction, capital goods, which have received a lot of support from the central government as well as state government capex. It is getting broad-based, but not to a wider extent because of last year's, patchy monsoon, uneven monsoon, and now also uncertainty about impact of El Nino on temperatures and how it would impact the yield of Rabi output, etc.
Yes.
So we have to, as Aditi rightly said, we have to keep our fingers crossed.
Well, yes, food prices and what happens with El Nino and, how these prices evolve in future, especially for vegetables, will be a make or break for what we see in the CPI numbers. But Devang, thank you very much for patiently waiting by all this while. We have most of the numbers. The core number especially is a big positive surprise. How will the bond market take this?
So I think you're right. I think core is at a multi-year low, and it actually should be a positive surprise for bond markets. But to be fair, I think bond markets are actually looking at many other aspects, or they're looking at what's going to happen on the CPI release, which is also there in the US markets today. How is the US Treasury going to react to it? I think somewhere down the line, the entire bond markets are also looking at how FPIs are participating. And I'm sure you have seen how FPI flows have been since the beginning of this year. We've already seen around close to 46,000 crores of flow in debt market. So I think bond markets are generally happy on account of FPI flows. The CPI continues to be in a range, and core CPI continues to be supportive for bond markets. As I told you, from our perspective, I think looking at the core number and an overall aspect on, unless and until we get a big shocker from US CPI data, I think bond markets tomorrow should be happy.
Devang, I wonder, are bond markets more going to be the deciding factor rather for the yields? Is more going to be the US CPI numbers or these India CPI numbers that we've just got?
I think, the India CPI numbers has been actually in line with expectation. We have not got any negative surprise. The positive surprise is bit on the core, but I think as the panelist highlighted, the veggie inflation has been slightly higher than what all of us were expecting. We were expecting the inflation to start falling.
Yeah.
And our perspective is the inflation has remained sticky around 5%. For the rally in bond markets to continue, we've already seen a handsome rally in the last 45 days in bond markets. For the rally to continue, I think we need now the global yields to probably trend lower. And once they start trending lower, I think we should continue to see some catch-up rally in Indian bond markets also. The focus would be on US CPI. So unless and until we get any significant shocker on the higher side, bond markets should be happy. If we get a surprise there also on the lower side, I think we'll see more positive in pricing bond markets tomorrow.
Okay, Aditi, let me come back to you on the core inflation number. Again, 3.3%. I think this is the lowest we've seen, according to our team, since January of 2012. This is the last set of data, big macro data, that the MPC is going to be working with when they meet next in early April. CPI number coming in lower, core inflation significantly lower, IIP holding up as well. How do you expect this to influence the policy decision?
There's one more important factor, GDP growth, which we got a few weeks back, which is above 8% for Q1, Q2, and Q3 of FY24 as per the latest numbers that we have. So I think if we go by that, certainly there will be no change in the stance or in the rates in April. And even with the CPI print, at least the headline is broadly in line with what most of the market was expecting. We certainly were expecting a 5.1% print. And a lower core inflation with the last three GDP quarterly prints being higher than 8% may not be enough to trigger a very quick change in stance or, immediate rate cut. I think there will be quite a bit of wait and watch. Definitely be very interesting to see the overall commentary as well as the individual MPC members' minutes on how they are viewing the overall GDP growth and the potential GDP growth going ahead. And maybe that will throw some light on whether or not a June stance change looks like it's going to be imminent. But as of now, looking at all the data that we have in front of us, I think this will be a status quo policy in April.
Okay, Nikhil, let me also quickly get your thoughts. This core inflation number coming down, IIP, of course, holding steady. We're also, always seeing this bit of a, conundrum between the two numbers, how core inflation is falling with growth holding steady. But quickly, your thoughts on, how these numbers materially change the action from the Reserve Bank.
So I don't think these numbers would actually change anything from the RBI's perspective. Inflation is in line with expectations, not only the market, but the RBI's as well. IIP is slightly lower, at least vis-a-vis our expectations. Growth otherwise has been really strong. If you look at other indicators, January, February, in fact, the fourth quarter of FY24 seems like there could be a positive surprise in that as well. And going forward, we see inflation hovering around 5% for the next couple of quarters before it started falling, supported by the base effect in the middle of FY25. So all in, I don't see RBI changing its stance or doing anything in the upcoming policy. The data does not suggest any change from the RBI. I think it's going to be in policy from the RBI perspective.
So, Nikhil, you're saying, we will be able to manage that 5% target that, or 5% estimate that RBI has for the first quarter of this current calendar year. We will be within that 5% range?
So for the first quarter, we are slightly higher than 5%. We are at close to 5.4%. But for the second quarter, we are seeing it at 3.8% vis-a-vis 4% that the RBI is. So on an average for the full year, we are at 4.6%. RBI is at 4.5%. Not a material change. So if inflation remains around 4.5% in FY25 and growth delivers what the market consensus is, we don't see any reason for the RBI to act in terms of interest rate cuts in CY24 at least.
Rupa, quick thoughts. Do you also believe we're on course to get to this 5% number, which is the target for the fourth quarter of the current financial year that RBI sort of estimated? And do you expect food to play spoil sport again? I mean, it remains quite high even in this reading.
No, I think 5% for the fourth quarter is achievable. We can't expect RBI to rush for either change in the stance or policy rates, because as they have been pointing out, recurrent and unexpected food price shocks, means in terms of magnitude, etc., that poses a lot of uncertainty for the overall inflation trajectory. And they now want to achieve 4% on a durable basis. So there is no way they will rush for any easing in the April policy. And after that also, they will hold wait and watch approach.
Well, absolutely. I think RBI has made it amply clear they want to see 4% CPI on a durable basis before they act, and we're still a while away from that. But, all of you, thank you very much for joining in, Aditi, Nikhil, Rupa and Devang, and helping us analyze these two key macro numbers, the CPI numbers and the IIP numbers. Just to quickly recap for our readers as well, good numbers on the IIP, 3.8% is the number that we have. And again, on CPI, the big positive has been the core inflation data that has come in at 3.3% compared to 3.6% that we saw the month before. February CPI overall headline number at 5.09%, coming down marginally from 5.1% that we saw in January. Rural inflation at 5.34%, holding steady. Urban inflation at 4.78%. Vegetable inflation remaining high, but as expected at 30.25%. Housing inflation at 2.88%, and so on. And of course, the IIP number, again, an important macro data to watch out for, 3.8% for the month of January. Mining at 5.9%, a slight growth over the previous month. Manufacturing at 3.2%, marginally down from what we saw in the month of December. Electricity growth very strong this month at 5.6% compared to 1.2% that we saw in the month of December. Consumer non-durables minus 0.3%. That sticks as a sore thumb, and consumer durables growth has been good at 10.9%. With that, we're going to wrap up this special discussion on the macro data on the state of the economy. Thank you very much for tuning in, but stay with CNBC TV18. Our other news and updates will continue after this short break.